In my opinion, it is never too late to get started with dividend stocks. I'm going to share a sample portfolio in the video today of how I would start with dividend stocks if I were starting over in my 40s, 50s, 60s, or even 70s. This dividend stock portfolio contains 15 positions. I'm going to go through all of those and why I would select those precise positions if I were starting over as an older investor, as an older dividend stock investor. And I'm going to tell you, even for investors who are starting out with dividend stocks and they're a lot younger, this video is still relevant because, quite frankly, starting like an older investor can make a lot of sense because the portfolio is going to be a little bit more conservative, a little bit more stable. It's going to provide a little bit more cash flow that can be used to pay bills. And then the younger investor can always work back from there and add in more speculative, more risky, more aggressive positions later. And so I have a lot of ground to cover today. This is a subscriber request video. And so actually, before we even get started, check out the pinned comment below and also the description below. I have a link to the free spreadsheet in the video today. All I ask is that you please go ahead and smash that like button and then go ahead and check out the free spreadsheet, follow along at home, and also don't forget to subscribe as well with the notification bell because I have so many dividend stock videos on the way. Get ready, everyone, for a really exciting dividend stock video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, so first I want to start with some words of encouragement because I get a lot of feedback on this channel, a lot of comments, and subscribers mentioned to me, hey Ian, I love this concept of dividend stocks, of earning passive income that I can use to pay bills, but I'm too old, I'm starting too late, I feel like I missed out. And so I want to share on the screen right now some thoughts of encouragement. In my humble opinion, it is never too late to get started with dividend stocks. And so those getting started later in life, quite frankly, have some advantages. One of those advantages is they may have more money to invest. People who are a little bit further along in life, especially like 40s, 50s, 60s, they're in those higher earning years of their careers. They may already have really good amount of savings in non-dividend stocks that can be used to invest in dividend stocks. And those who have started younger, maybe they had that advantage of starting younger, but quite frankly, their portfolios, they may not have as much of an edge as you think. They may have not deployed as much money as you think because younger investors oftentimes have lower salaries because they're newer in their careers. And there's all kinds of other expenses when you're younger as well, especially as you're getting started with a family, if you have kids, so on and so forth. You're buying your first car, you're buying a car, you're buying your first house. And so for example, older investors who may be at a life stage past some of those things, oftentimes they're doing just fine and it's definitely not too late. So check it out on the screen right now. Also, what I want to share is we're all living longer. And so let's say you're watching this right now and you're in your 50s or 60s and you're like, man, I wish I started dividend stocks sooner. Well, honestly, 60 years old, it's like the new 40 now, quite frankly. We're all living longer. And that's something to keep in mind. And so also this world is full of geo-arbitrage. And so if you're thinking, quite frankly, you're starting a little bit older, you're worried you're not going to be able to save or deploy enough money, keep in mind that our world right now is really global and there are opportunities to live in other countries a lot cheaper that did not even exist before the modern internet. And so also worth noting is many investors, it's not only about driving cash flow for themselves, but also it's about leaving a legacy for a family or for charitable causes. And so even if you're starting older, let's say you're starting even in your 70s and you don't feel like you're going to be able to deploy enough money in your lifetime maybe to fully live off of the dividends, that portfolio can still have a lot of meaning for future generations. The future generations can enjoy the benefits of your hard work. You can leave a legacy. You can even leave a legacy for charitable contributions. And so with those words of encouragement, I want to keep moving. Check it out on the screen right now. What I want to do next is start with some common mistakes. So if you are starting out later in life with dividend stock investing, one thing I will say is that it is really important to avoid mistakes, because I'll tell you, when I started with dividend stocks all those years ago and with investing in general, I've made every mistake in the book. I've done so many videos here on YouTube about my mistakes. I shared a video recently, which I'll link to in the description below, of how I've lost tens of thousands of dollars on angel investments. And so I've made that mistake. And I'll also link in the description below about my top 5 investing mistakes. I've made all the mistakes in the book. I even tried out penny stocks at one point. And so basically, younger investors, they have that luxury. I've had that luxury. I've learned the hard way. But what I would say is, for investors who are getting started a little bit further along in life, it's going to be really important to avoid those mistakes. And it's also going to be really important to avoid the psychological temptation to play catch up. Because when someone tries to earn money quicker, make money quicker in the market, earn more cash flow in the market, have some kind of competitive edge to play catch up, that's when emotions get into the picture and mistakes are made. So as you can see on the screen right now, basically it's very important to avoid going too aggressively and trying to play catch up. It's also really important not to invest too much money too quickly in order to catch up for not starting sooner. And obviously, choosing riskier stocks as an older investor makes no sense. There's no catching up. I mean, maybe there is with extreme risk and getting lucky, but this concept of playing catch up, in my humble opinion, is something that must be avoided for older investors, especially investing a lot of money. Now, solutions, in my opinion, and this is not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. But these are some solutions. And someone starting a bit later basically has less freedom to make mistakes. So extra caution is warranted, as I mentioned. I think someone further along in their life should practice dollar cost averaging. So not deploying all the money at once, but spreading it out over time. Someone starting later generally, and you'll see this in the portfolio that I share later, probably ought to look at more conservative stocks, stocks that are not as risky, stocks that are more sustainable. And what I would also say is it's important to have very realistic expectations as someone getting started later. There's no gaming the system. There's no workarounds. It's all about slow, steady, brick by brick by brick, and you'll see this in the portfolio later. Let's keep going. So check it out on the screen right now. Next, what I want to share is just something about understanding your goals. And so really, this is a channel about dividend stock investing, and so there's kind of 2 goals that come to mind. One is just immediate cash flow now for living expenses. That's really how I am approaching this video, because generally when I get questions from the community, hey, Ian, I'm getting started a little bit older, the question is really about, hey, I don't have many years left until retirement, and so I need cash flow now. And so the portfolio that I'm constructing today is for that scenario. It's for someone that wants to drive cash flow right now. But the other goal that I get through this channel a lot is, hey, yeah, I want some cash flow now, but I'm really looking for that to snowball and compound over time and have much more cash flow later. Honestly, if you're in bucket number 2, that's what my portfolio is about. That's what I've constructed for myself. I'll link to it in the description below, my personal dividend stock portfolio. But what I'm trying to focus on today is the first bucket, those investors that want cash flow right now. And I'll tell you again, to reiterate, I think this is very important. Even if you're not in your 40s, 50s, 60s, 70s, or later, starting with a more conservative kind of cash flow now portfolio can make a lot of sense, because it's that foundational element of a portfolio that can be built upon. over time. And so I want to go through now the theory of building the portfolio, and then I'll get into the portfolio. So check it out on the screen right now. And so the theory is basically I would diversify by industry, and industries for someone later in life are going to be more conservative industries, less volatile ones. For example, I would avoid technology most likely, but consumer packaged goods, food, utilities, industrials, healthcare, sin stocks, REITs, those are the types of industries. I would diversify by time, so deploy money slowly and steadily. I would also generally buy value. And so investors starting a little bit later, they don't want to assume as much risk in terms of valuation because they're not at a point in life where it makes a lot of sense to buy really low dividend yields, really high PE stocks. There's just not enough time for it to catch up. I'll give you a perfect example. Apple. I own Apple stock. I love Apple. And they just had blockbuster earnings. The dividend yield on that stock is so low, and the PE, it's higher, that we're looking upon decades for any kind of meaningful cash flow to come out of it. Personally, I'm looking at it almost more multi-generationally. But what I would say is someone starting a bit later, like 70s, for example, buying Apple stock, maybe that would make sense for future generations. But for that investor, if that investor is looking to live off of cash flow from dividends, Apple dividend, it's just not going to catch up. And from a PE ratio on cost standpoint, the PE ratio isn't going to ever get to a reasonable PE on cost either. Let's keep going. Check it out on the screen right now. And so next, what I want to say is consider buying stocks that pay different months. I did a whole video, and I'll link in the description below, about my dividend payments. I have over 173 now, but when I did the video, I had 173 dividend payments per year, and those are spread out by calendar month of the year. And so you can check out what types of stocks pay dividends in different months from that particular video. Now, what I would say is it may make sense for an older investor to consider some, in terms of technology, there's a new technology on blockchain, stable coins, and US dollar coin might make some sense for someone in that bucket earning 9% interest for intermediate term money. I'll get a little bit more to this later. It'd be a very small percentage of the portfolio, but it could give some nice cash flow bump. And another idea is it may make sense for someone in this situation to add an ETF. I was looking actually at the Dividend Aristocrat ETF, but honestly, that starting yield was under 2%, and the expense ratio was high enough where I just couldn't rationalize it. For someone who needs cash flow now, who's a bit older, boy, it's just never going to generate enough meaningful cash flow, in my humble opinion. But if the market were to correct, if there were other ETFs out there, I'm not an ETF expert, but there may be ETFs out there that could provide a little bit stability, because the benefit of an ETF is you get instant diversification. And this could be important for an older investor, because older investor, again, doesn't want to take on a lot of risk. I got started really early in my life, and because of that, I've taken on tremendous risk over the years, but I couldn't see myself doing that if I were starting over today, for example. And so if I were starting over today, for example, what I would do most likely is construct a portfolio like the one I'm about to show, and then I would layer in some of the more risky and speculative positions that I've got. But I would say in general, as far as dividend investors go, I am a bit more on the aggressive side of things. I do like to take on a little bit more risk than many investors out there. So without making you all wait any longer, I know you've all been waiting for this. Check it out on the screen right now. This is the dividend portfolio that I constructed for this particular scenario. And so as you can see on the screen right now, there are 15 basic positions. And so what I do is I first bucket 13, and then I have 2 below. The reason I separate the 2 on the bottom is they're different assets. One is a real estate investment trust. One is a cryptocurrency. And so those two make sense to segment out. Just as I do subtotals in this spreadsheet, they throw off the numbers. And so I'm not going to go through every metric on here because there sure is a lot to cover. But what I want to generally cover are some themes. And themes that you can see are I bucket stocks by industry. So you can see I have Johnson & Johnson, Pfizer, VTRS, and ABBV that are all healthcare stocks. Why do I, and honestly, when I add up the position percentages to these, I've got 26.75% of the portfolio in these healthcare stocks. The reason for this, honestly, is the PE ratios are really good. And so if I average the 2021 forward PEs on these, I get an average of 10.48. In 2022, it's even lower at 10.13. I also get a staggering dividend yield average, simple average on these, of 3.54%. And it's only going to go up from there because they have really good dividend growth rates, especially ABBV that has a 5-year compound annual growth rate of 17.9%. And so one of the things you're going to notice on the spreadsheet is certain cells are highlighted in yellow. I highlight the ones in yellow that are of particular interest to me, whether they point out something that's very beneficial for the company, such as a low PE, such as a high dividend yield, such as a high compound annual growth rate on the dividend. And so those positions that I start with in this portfolio are the healthcare ones. And quite frankly, if I were starting this portfolio today, I would be focused on healthcare really aggressively. J&J, it's probably a fair value right now, but the other three, Pfizer, AbbVie, and VTRS, those are all trading at discounts right now. And so those are really good, solid stocks, in my humble opinion, right now, because they check all of these boxes. They give high current yield. They give good value because the PE ratios are low. They actually give an element of dividend growth, which is something important because someone starting right now, older, not only does that investor typically want the cash flow to pay bills, but we have inflation. We all know that right now. Just look at the price of lumber, for example. It's going through the roof. I was at the gas station today and it cost $75 to fill up the tank. And so things are getting more expensive. And so investors who are older, they want that element most likely of dividend growth. And it's nice to see that these pharma stocks, these healthcare stocks, they check all the boxes. I don't see a ton of downside on these because I believe they're trading at reasonable PEs. I see growth at these companies. I see dividend growth at these companies. And so I think they provide a really good base for this portfolio. Let's keep going. Check it out on the screen right now. And so what comes after healthcare is I've got my consumer packaged goods food stocks, and those are PepsiCo, which is a beverage company, General Mills, which is a pet food company, and also a cereal company, and also just like a healthy foods company. They own the Annie's brand of foods. And then I have Campbell's Soup, which is largely a snack food company. They own Pepperidge Farm, which owns Goldfish. They also own their iconic Campbell's Soups, of course, but it's more or less, I would say, a salty snack food company with a soup component. And so those are the food stocks I got. And when I look at those food stocks, if I add up the percentages, I have 20.25% in them. And these particular stocks, they're trading a bit more expensive. Of the three, the only one that I really highlight on a PE basis is Campbell's Soup, because that one I think is still trading at a discount. I'll probably pick up some more soon. I love this stock. But the average PE on these 2021 is a 19, very fairly valued right now. I wouldn't say deep discount. Although overall, this is a more expensive market right now. Now, from a dividend yield standpoint, I actually like General Mills the best because it's trading at a 3.21% dividend yield. And so also from a compound annual growth rate perspective, I highlight Pepsi because that one is growing the quickest. Now, one of the other things I would mention out of this study today is not only am I diversifying by industry, not only am I diversifying by market capitalization, I have stocks of all different sizes, I'm also diversifying by internationally, by the globe, for example. So Campbell's Soup is largely a U.S. company that does the lion's share of their sales in the U.S., but PepsiCo, for example, is a very broadly based international organization. They're based out of the U.S., but their sales come in all over the world. And I do have some pure play international companies in the presentation today as well. But I find it very important for someone, really for any investor, to have the stability, not just of relying on any one country, but relying on the entire globe. And so I love consumer packaged good food companies because everyone needs to eat. And also, pets need to eat. And so we cover that through General Mills. Let's keep going. Check it out on the screen right now. And so the next one that I want to go through are my consumer packaged goods, kind of basic needs type companies. And there's two that I include here, Kimberly-Clark and Unilever. One of the things that you guys are probably thinking at home, Ian, why are some of your ride or die stocks missing from here? Quite frankly, this market right now is very expensive. Stock prices are through the roof. PE ratios are through the roof. It's really hard, honestly, for someone starting out in dividends or any kind of investing now, whether they're 20 years old or 70 years old. All investors face the challenge now that valuations are really high. And so some of the reasons that I have some of my ride or die stocks on here, like Kimberly-Clark and Pepsi, J&J, but some of mine are missing. The reason that many of my ride or die positions are missing is they're just too expensive. And for someone who needs to drive cash flow right now, I just don't see how it would be possible to buy some of the stocks that are on my ride or die list at such high valuations. But anyway, check it out on the screen right now. I want to go through these two, Kimberly-Clark and Unilever. I think both are at great values, and they provide those products we all need at home. Like Kimberly-Clark, for example, provides Kleenex and also toilet paper. Unilever has a huge portfolio of health and beauty related products, if you will, soaps like Dove soap. They also have some foods in there too, like Ben & Jerry's, but I really love Unilever for kind of that beauty segment. And so these ones I don't highlight at all because they're trading honestly at fair valuations, but at least they're not overvalued like some of my other CPG stocks. But Kimberly at an 18 PE, Unilever at a 20, and these are on forward 2021 PEs. They're fairly valued. But again, I select these because all of the other alternatives that I love just as much as these stocks, they're even higher valuations on those. And so I love the starting dividend yields on both of these of 3.35 on Kimberly, 3.42 on Unilever. And the 5-year dividend growth rate on Unilever is really great at a 7%. Now, I did calculate that off of the ADR, so there are some currency fluctuations in there because this one's based off of US dollars. And so after these exciting stocks in healthcare, consumer packaged goods food, and consumer packaged goods just household needs, I want to get into something that may be a little bit more boring, but it's so foundational. We all need electricity and energy to live. I have all of these bright lights on me right now as I record this video, and they require power. And so what makes a lot of sense, I think, for a portfolio for someone looking for cash flow now, who's starting a little bit older, who wants that conservative portfolio, doesn't want to take on a lot of risk, I think regulated electric utilities are really good. And so check it out on the screen. There are two that I select here, Southern Company and Duke. Both are U.S. companies, and they skew very U.S. in terms of their business. Now, thankfully, I have some other companies on here that skew internationally, like Unilever, which is an international company. As I mentioned, Pepsi, I've got J&J, which does a ton of international sales as well. Anyway, with Southern and Duke, you've got a lot of U.S. exposure, and these comprise 12 or 13.25% of this portfolio. And with both of these, quite frankly, they're trading at high PEs. I wouldn't say they're overvalued, but they're good. They got a good valuation. But again, I can't envision doing this type of portfolio, quite frankly, without some utilities. And the reason is the dividends. And I have basically most of the dividend yields highlighted on the screen. Southern is at 4%. Duke is at 3.84%. Good, solid dividends. And they do grow. The 5-year compound annual growth rate on Southern is at a 3.3, 3.2 for Duke. And what I would say about these is I don't expect any capital appreciation at this point, but they pay a good, solid dividend yield. These companies aren't going anywhere. Everyone needs energy. They're regulated by the government. Another competitor is not going to come in. Obviously, solar panels and such could be a long-term competition to these types of companies. That being said, I think there's enough business to go around, and they're regulated monopolies, if you will, by the local governments. And so I think these are really solid companies that provide cash flow for someone who needs cash flow right now to pay the bills. And thankfully, that stream of cash flow will also grow over time, although a little bit slower than some of the other stocks included. Let's keep going. Check it out on the screen right now. And so next, I want to get into some different industries. You could say Philip Morris is a sin stock. You could also say it's consumer packaged goods, kind of food. And if you call it food, I guess it generally would be lumped into a similar category as some of those CPG stocks I already mentioned. But basically, it's a sin stock. I include this stock because it's perpetually on sale, and it's trading right now at a forward PE of 15.98, next year of 14.56. Thankfully, we're getting into value territory again. I love that juicy starting yield of 4.96, and I love the fact that this company only does business outside of the U.S., so they don't have to mess around with the FDA, the Food and Drug Administration, because doing business in the U.S. in the sin stock category can be very difficult, as we all know, or as many of us in the community know. And so being a more conservative portfolio, that's why I included Philip Morris. And it does have some dividend growth as well, although it's been a little bit slower at only 3.3% on average for the last 5 years. Now, I'm trying to go through all of the different categories. The next company is a bank based out of Canada, Bank of Montreal. And so check it out on the screen right now. I'm giving some exposure to the financial services space in this portfolio. And you'll see roughly, quite frankly, the percentages here. I don't try to over-allocate or under-allocate any one position. I just make them kind of even. Some are 6.5%, some are 6.75%. Obviously, if I were starting this portfolio myself, I wouldn't just deploy all the money overnight. I would dollar cost average into the ones that are most on sale right now. The ones I think are most on sale right now would be companies like Pfizer, VTRS, ABBV. I would say Campbell's Soup. I would say Philip Morris. Those would probably be the ones that immediately come to mind. And so maybe even Bank of Montreal, it's got a forward P of 14, although we have to be careful with that because banks are always trading lower. It's just a different PE ratio applies to that class of stocks versus something like consumer packaged goods like a Unilever, for example. But I like Bank of Montreal because of the international exposure. I like the fact that it has a dividend yield of 3.45%. And I think it's a solid bank. Now, they also have grown the dividend on average by 6.5% over the last 5 years. That's their compound annual average growth rate. Not bad. And so I like this company, and I include payout ratios here as well. And that one is just under 50%. And so what I do now, I have some other stocks. So actually 2 other assets, a real estate investment trust and a crypto coin. But before I get into those, I just want to subtotal everything because those ones are not really comparable. So if I subtotal the first 13 positions, I have that in the green cells. And what you see right now basically is that the forward PE for 2021 on average is a 15.94. Now that does get pulled down quite a bit by ABBV and VTRS, but nonetheless, it's a 15.94. I'm pretty proud of myself for constructing a portfolio with a PE of 15.94 in this market, which is so expensive right now. But quite frankly, we don't know if the market's going to get cheaper because we're in an inflationary environment where people are getting money out of fiat currency and into assets like dividend stocks to protect and grow their wealth. And so I don't know if the market will correct. I hope it corrects. If it corrects, that's a perfect opportunity for someone starting to average down, averaging slowly all the way down, all the way back up. I'll tell you, if you're starting brand new right now, it's generally not a good thing for the stocks to keep going up. It's so much more satisfying for a dividend investor to buy when stocks are tanking, when they're collapsing, like I was last year during 2020 when everything was going nuts with the pandemic. I was buying almost every day because of the opportunities that I saw. Now, unfortunately, in 2021 right now, things have just gone through the roof, and so it's expensive. But dividend investors hope for corrections because as stocks go down, we can all get a better price, a better purchase price, and also with better purchase price means better starting dividend yields because as share prices go down, dividend yields go up. And so anyway, check it out on the screen right now and you can see those averages again. And what I love Also is the dividend yield is 3.56%. But again, there's an opportunity for that to go up over time because all of the stocks I'm sharing today tend to increase their dividends over time. And in fact, the average is 5.8%. So even someone who is not reinvesting the dividends, because someone with this type of portfolio is probably looking to live off of the dividends or at least use the dividends to pay some of the bills and maybe work part-time, the dividends aren't going to get reinvested. And so for someone in that particular case, what's most important is basically just looking at 5-year compound annual average growth rate for the dividends, and it's 5.8%. So this investor on average could expect income to increase by 5.8% per year. Now, one of the challenges right now with any investors, we live in an inflationary environment. And I'd also say for an investor who's older and also investors who are younger, quite frankly, it's good to try to fix as many costs as possible. This is why, despite home prices being really high, getting into a fixed mortgage, at least fixing in prices, that's probably why home prices are going up, because people are looking to fix prices, because rental rates can always go up, but owning a home and paying a fixed rate mortgage, the price isn't going to go up. It's a fixed monthly expense. And unfortunately, we live in an environment right now that has basically, I would say, inflation that is a bit out of control. I'm not so sure it will come under control. We're seeing this with lumber prices. We're seeing this with the price of oil. We're seeing this with the price of new and used cars. I'm even seeing this with watches. When I went to the watch store, all the watches, the fancy watches, were all gone. Why are they gone? Everyone is trying to get their money into something that's more stable than fiat currency. It's a weird world we live in right now. Anyway, let's keep going. Check it out on the screen right now. Keeping it positive here. The next one is a real estate investment trust. It's Realty Income. This one I have to include down here because some of the metrics are a little bit different. And their 2021, 2022 EPS, I actually just used the trailing, I used the 2020. So this is prior year EPS, and it's actually not EPS, it's AFFO, adjusted funds from operations, but it's trading at a trailing or a prior year AFFO of 19.93 PE. Price to AFFO. So it's not trading at a deep discount or anything, but I think this company, honestly, they're making some big moves here. I was just reading their investor deck today, and they're basically purchasing another company. They're finding a lot of synergies. They're finding the opportunity to unlock shareholder value instantly. And so I think there's some synergies around the corner, some opportunity for this company that makes it attractive even at that 19 AFFO on 2020 AFFO. And so I like it here. And what I like even more is you can see in front of your eyes on the screen right now is that it starts at a 4.17% dividend distribution yield. Now, this is a real estate investment trust, and so it's not taxed the same as all of the stocks above, which are qualified dividends, which are taxed as long-term capital gains tax rate, although tax system here in the U.S. is completely in flux. We'll see what happens with it. But as of now, Realty Income is a real estate investment trust, and that is taxed. There are two components to it. One is part of the distribution is taxed as ordinary income, which is the same as short-term capital gains, and part of it is taxed as return of capital, which actually isn't taxed, but it increases cost basis. And so the last one may be a little bit controversial, but some of you know I have a cryptocurrency channel. I'll link to it in the pinned comment below and in the description below. Check it out. It's really cool. It's called PPCE in Crypto. And one of the things I do on the main thing I do on my crypto channel is I talk about crypto for cash flow. I invest in crypto for cash flow. And there are stable coins. The example of a stable coin is the US dollar coin. This is a coin that was invented that is pegged to the US dollar. It has physical dollar reserves to back it up. It is not FDIC insured, but the dollar reserves are audited. And there's a lot of these US dollar coins now. There's actually, as you can see on the spreadsheet, 14 billion of them under market cap. And US dollar coin is sponsored by Circle. And what's so cool is if you own it in a platform like Voyager, you can earn interest on it. And right now the interest rate is 9%. And so getting a 9% interest, again, it's taxed as ordinary income because it's interest. 9%, it skews the yield up for the entire portfolio. And so I think a small position in something like a stable coin, like US dollar coin, on a platform like Voyager, for example, could make sense for someone in this particular situation because it offers such a high starting yield and it kind of gives that bond-like component to the portfolio. And I know a lot of people, especially investors who may be a little bit older, might get spooked here when I'm talking about cryptocurrency for a conservative portfolio for someone who is not looking to lose or risk money. But what I'm saying is this is a crypto that is pegged to the dollar, so it does not go up or down. It is pegged 1-to-1 with the dollar, but it offers the opportunity for interest. And so if you want to learn more about that, I have a whole crypto channel about it. And if you want to buy US dollar coin, one way to do so is on Voyager. I'll link in the pinned comment below. If you actually use my referral link to Voyager and deposit $100 and trade it into a crypto asset like US dollar coin, you'll earn $25 in free Bitcoin, as will I. And in terms of full disclosure, I am a Voyager customer and also affiliate. I love Voyager, and so I talk about it at length on my crypto channel. But anyway, check it out on the screen. I want to do a grand total summary now. And so, yeah, the two assets here at the bottom are a little bit different than the ones at top. And so I can't really compare like PE ratios. There's no PE ratio on US dollar coin. It's just a peg to the dollar. It's a dollar, digital dollar, if you will. But what I can do is I can look at overall cash flow. And the 3.56% now bumps up to 3.96%. So I've constructed a portfolio of 15 different assets. 13 of them are dividend stocks. One of them is a real estate investment trust. One of them is a stable coin, cryptocurrency. And overall, I'm getting a starting dividend yield of 3.96%. And so 3.96%, and it will grow over time because everything on here other than US dollar coin is going to most likely continue to grow the dividend over time. US dollar coin, quite frankly, that 9% interest, it might even go down over time as the industry matures. The interest rates might not be so high in the long run, but in the short run, at least, they're long or they're high, and it's an interesting way to earn some great passive income at a really high interest rate on that stable coin. But I'd be curious, what do you think about this portfolio for someone getting started a little bit older, or even for someone starting younger who wants to start a little bit more conservatively and see the money now in this really expensive stock market? What do you think? Put in the comments below. If you enjoyed the video today, please go ahead and smash the like button. And also don't forget, I have that free complimentary spreadsheet below. And also, if you really enjoy the video, you enjoy the spreadsheet, it would mean the world to me if you could subscribe as well. I am on my way to 100,000 subscribers, and I'm doing everything I can to get there as quickly as possible. That is my dream. Also, if you enjoy the content and you want even more content, I have 31 videos now on my Patreon. I'll link to that in the pinned comment below. And there are over 170 now who have signed up for Patreon. It's only $3 a month, and you can cancel at any time. And there's 31 videos. There's all kinds of resources there as well. I got a lot on there, a lot of great content as part of Patreon. All right, everyone, before I leave today, in terms of full disclosure, I am long Apple, ticker symbol AAPL. I am also long all of the stocks in this spreadsheet. Johnson & Johnson, ticker J&J, Pfizer, ticker PFE, Viatris, VTRS, ABBV, ABBV. I am long PepsiCo, ticker symbol PEP. I am long General Mills, ticker GIS. Campbell Soup, ticker symbol CPB. Kimberly-Clark, KMB, Unilever, UL, Southern Company, SO, Duke Energy, DUK. Philip Morris, PM. Bank of Montreal, BMO. Realty Income, O, and USDC, US dollar coin. Also, in terms of full disclosure, I'm a Voyager affiliate. Also, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm just sharing my personal journey here on YouTube for fun and entertainment. I'm just speaking hypothetically today about my personal situation if I were starting over again as an older investor. And it's very important to realize the stock market has really gone through the roof because of all this inflation, because of all these dollars and fiat currency it's been printed. Stock market is through the roof, and we just don't know what the future will hold. And so it's a risky thing to invest in the market. It's important to keep that in mind. It's especially risky these days. All right, everyone. I love you all. I hope you enjoyed the video. I'll see you in the comments below, and I'll see you in the next video.